You have $3,000 sitting in your Chase savings account right now. Maybe it's $5,000. Maybe it's $10,000. And every single month, that money sits there, completely still, earning you what? $1.50? Maybe $3. And you don't even think about it. You log into your app, you see the balance, you feel okay about it, and you move on. That's the trap. That's the exact financial behavior that's quietly costing you hundreds, sometimes thousands of dollars every single year, and nobody around you is talking about it. My name is Vicky, and I spend way too much time thinking about where people store their money and why they're getting robbed in plain sight because of it. If you're someone who works hard for every dollar, but still feels like your savings are going nowhere, hit subscribe and give this video a thumbs up, because what I'm about to break down could genuinely change how you think about cash forever. Let's start with something uncomfortable. Most people treat their savings account like a parking lot. You drive in, you leave the car, and you come back, and it's still there, safe, unbothered. The problem is that parking lots don't pay you, and when inflation is running at 3%, 4%, even 5% in a given year, that parked money is actually shrinking in real purchasing power while you think it's just sitting quietly. Here's the thing. Money that isn't growing is technically dying. Every year, that $10,000 sits in a big bank account earning 0.01% interest, which is the national average for traditional savings accounts according to the FDIC. You are handing your bank a gift. You are giving them your money. They're lending it out at 7%, 8%, or 10%, and they're giving you back $1 at the end of the year, $1 on 10,000. That is not a savings account. That is charity for a $1 trillion institution. Now look, I'm not here to demonize big banks entirely. JP Morgan Chase, Bank of America, Wells Fargo, they built massive infrastructures. They have branches on every corner, and that convenience has real value. But here's what most people don't realize. You are paying for that convenience with your savings rate. The overhead costs of running thousands of physical locations, paying tens of thousands of employees, maintaining ATM networks. All of that gets passed back to you in the form of near zero interest on your deposits. You are subsidizing their real estate portfolio with your financial stagnation. And the wildest part? Most people have no idea there's an alternative, or they've heard about high-yield savings accounts, but they've convinced themselves it's complicated, risky, or just not for people like them. Let me dismantle that right now. A high-yield savings account, let's call it an HYSA from here on, is exactly what it sounds like. It's a savings account that pays you a dramatically higher interest rate than what your traditional bank offers. As of recent Federal Reserve rate cycles, many of the top HYSAs have been offering annual percentage yields, APYs, anywhere between 4.5% and 5.5%. Compare that to the 0.01% to 0.46% that most big banks are quietly offering, and the math becomes almost offensive when you stare at it directly. Here's the financial math. Let's say you have $15,000 in savings at a big bank paying you 0.46% APY, which is actually on the higher end for traditional banks. After 1 year, you've earned roughly $69. $69. Now take that exact same $15,000 and park it in a high-yield savings account paying 5% APY. After 1 year, you've earned $750. $750. That's not a small difference. That's $681 you left on the table by staying loyal to a bank that barely knows your name. Over 5 years, with compound interest, that gap widens dramatically. The FDIC insured, completely liquid, zero-risk money you thought was safe was silently underperforming by hundreds of dollars annually. And most people never noticed because they never looked. This is where it gets interesting. And this is where the psychology comes in, because the math alone should be enough to make everyone switch immediately. But they don't. Studies in behavioral economics, particularly work rooted in what researchers call status quo bias, show that people have a deep, almost irrational preference for keeping things the way they are. Switching banks feels like effort. It feels unfamiliar. The big bank has your direct deposit, your linked accounts, and your years of transaction history. There's an emotional attachment to familiarity that has nothing to do with logic and everything to do with comfort. Banks know this. They have always known this. The entire business model of a large retail bank depends on your inertia. The moment you stay because switching feels hard, they've won. Now you might be thinking, okay, Vicky, but is my money safe in one of these online high-yield accounts? And I want to address this directly and honestly because it's a fair concern. The answer is yes, provided you're using accounts that are FDIC insured. The Federal Deposit Insurance Corporation insures your deposits up to $250,000 per depositor, per institution. The most reputable HYSAs, institutions like Marcus by Goldman Sachs, Ally Bank, SoFi, Discover, American Express National Bank, and others, are all FDIC insured. If those banks fail, which is extraordinarily rare, your money is federally protected up to that limit. It's the same protection your Chase or Bank of America account has. Same shield, dramatically different return. Let me give you a real-life scenario because numbers without context are just numbers. Imagine two people. Let's call them Dana and Marcus. Both are 29 years old, both earn similar incomes, and both are decent savers. Dana keeps her $20,000 emergency fund at her traditional big bank, earning 0.46% APY, because she's always banked there, and switching just never felt urgent. Marcus moves his $20,000 to a high-yield savings account at 5% APY. He takes one afternoon, opens the account online, links his existing bank, and transfers the money. Now let's fast forward 5 years, assuming rates stay somewhere in that general neighborhood. And yes, rates fluctuate. I'll get to that. Dana has earned roughly $460 in interest over 5 years. Marcus has earned approximately $5,526 because compound interest is doing the heavy lifting for him. That's a difference of over $5,000 from the exact same savings. Same discipline, the same amount, the same risk tolerance, a completely different outcome because of one decision Marcus made on a Tuesday afternoon. Here's the thing about rates fluctuating, because someone in the comments is about to bring it up and I want to address it head on. Yes, HYSAs are variable rate accounts. When the Federal Reserve raises interest rates, HYSA rates go up. When the Fed cuts rates, they come down. This is real, and you need to know it. But here's the framing that matters. Even in lower rate environments, high-yield savings accounts consistently outperform traditional bank savings accounts. When big banks were offering 0.01%, top HYSAs were offering 0.5% to 0.7%. The spread between them doesn't disappear. The advantage persists across different rate cycles. You're always ahead. Maybe sometimes less dramatically ahead, but always ahead. Now look, a high-yield savings account is not an investment. I want to be crystal clear about this because confusing savings tools with investment vehicles is one of the most common and costly financial mistakes people make. An HYSA is not going to make you wealthy. The stock market has historically returned an average of roughly 7% to 10% annually over the long run. Your HYSA, at its best, barely keeps pace with moderate inflation. What it is the best possible tool for money that needs to be liquid, stable, and safe. Your emergency fund, 3 to 6 months of living expenses that you cannot afford to lose, belongs in an HYSA. Your house down payment that you're saving up for, a car you're buying in 18 months, a business investment you're building toward. That cash has a job, and its job is to wait without losing value. The HYSA is the best seat in the house for earning money. Here's what most people don't realize. There's actually a psychological benefit to having your savings in a separate institution from your checking account. When your emergency fund is one tap away in the same banking app as your daily spending account, it's incredibly easy to rationalize touching it. I'll just borrow from savings for this one thing and put it back next month. Sound familiar? When your high-yield savings account is at a different bank entirely, especially one without a debit card or instant transfer, there's just enough friction between you and that money to protect it from your own impulsive decisions. Behavioral economists call this a commitment device. It's not about willpower, it's about engineering your environment so the right choice is also the easier choice. This is where it gets interesting from a practical standpoint. Let me walk you through the actual process of opening a high-yield savings account, because I think the friction feels bigger in people's minds than it actually is in reality. Most of the top HYSA providers have a completely online application. You need your Social Security number, a government-issued ID, and your existing bank account information for the initial transfer. The whole process, from opening the tab to having a verified account, takes somewhere between 10 and 20 minutes on average. The initial transfer can take 2 to 3 business days to clear, depending on the institution. And then it's done. Your money is there, earning a real rate, with zero ongoing management required from you. It's genuinely one of the highest return on time financial moves available to the average person. 15 minutes of effort for hundreds of dollars in annual earnings. Now, which accounts should you actually look at? I'm going to give you names without being a paid spokesperson for any of them because I think you deserve honest information, not sponsored confusion. Marcus by Goldman Sachs has been a consistent top performer with a clean, no-fee structure. Ally Bank has one of the better user experiences in the digital banking space and a strong reputation for customer service. SoFi offers competitive rates and has the added benefit of direct deposit bonuses. American Express National Bank, different from Amex credit cards, has a strong HYSA product with no minimum balance requirements. Discover Bank's online savings account is another solid choice with zero fees and a long track record. You can find updated rate comparisons on sites like Bankrate, NerdWallet, or deposit accounts, and rates shift, so it's worth checking what's competitive at the time you're watching this video. Here's something I want to layer in that almost nobody talks about: the relationship between high-yield savings accounts and your overall wealth-building architecture. Because the mistake I see people make, even financially curious people who've done their homework, is treating their money as one big pool. They have a checking account, a savings account, and a brokerage account, and everything kind of bleeds together. The sharper framework is what I call money with a job. Every dollar in your financial life should have a specific role and a specific home that matches that role. Your emergency fund belongs in an HYSA, liquid, safe, and earning. Your long-term investment money belongs in index funds or a diversified portfolio, illiquid tolerant, growth-focused. Your short-term savings for specific goals, HYSA. Your retirement savings, Roth IRA, 401k, are growing tax-advantaged. When every dollar has a job and the right tool for that job, your entire financial picture becomes more efficient, more intentional, and frankly, less stressful. The psychology of financial clarity is underrated. When you know exactly where your money is, what it's doing, and why it's there, you make better decisions across the board. You stop stress spending because you feel financially chaotic. You stop undersaving because you can see the real progress happening. And you stop leaving money on the table because you've built a system rather than just a habit. Let me address one more objection before I bring this home, because I know some of you are thinking it. Vicky, my big bank has all my accounts connected. My checking, my credit card, my mortgage, my car loan. If I move my savings, it's going to be a mess. Here's the thing. You don't have to close your big bank account. Keep it. Keep your checking there. Keep your direct deposit there. Keep your linked accounts exactly where they are. All you're doing is moving the savings portion, the money that's supposed to be earning, to a place that will actually treat it properly. The two accounts can coexist. You transfer money between them when needed. The big bank doesn't disappear. It just stops holding your savings hostage. At the end of the day, here's what this comes down to. Your money is working either for you or for your bank. There is no neutral. Every month that your savings sit in a traditional account, earning next to nothing, you are making a quiet, unconscious decision to prioritize their profits over your own. And the wild thing is that switching costs you nothing. There are no fees to open an HYSA, no penalties for moving your money, no minimum balance at most of the top providers. The only thing standing between you and a meaningfully higher return on your savings is the 15 minutes you haven't yet given yourself. Stop letting comfort be more expensive than change. Open the account. Transfer the money. Let compound interest do what it's designed to do. Because in 5 years, you'll look back at this moment either as the day you finally stopped giving your bank a free loan or as one more video you watched and didn't act on. The math doesn't care which one you choose, but your future bank balance very much does.